Something absolutely shocking is happening in the UK property market right now. House prices are dropping faster than anyone expected, and if you're not paying attention, it could be the biggest financial mistake of your life. But here's the twist. While some people are losing tens of thousands of pounds, others are quietly positioning themselves to make one of the smartest moves they'll ever make. Whether you own a home or trying to buy one, or are thinking about investing, the landscape is changing in ways that could either save you or cost you. Over the past year, the national average for house prices has dropped roughly 3 to 4%. That might sound like a minor correction, but when you dig into the numbers, the reality is much more dramatic. In London and parts of the southeast, some postcodes have seen drops of 6%, 7%, even 8%. Imagine a property that was listed at $600,000. Just 18 months ago now, struggling to sell for $550,000. That's $50,000 gone in less than 2 years, and this isn't just about numbers. The market isn't falling uniformly. Some areas remain resilient, clinging to inflated values that simply can't last, while others are seeing the kind of price drops that homeowners can barely recover from. But the really interesting part? Behind these declines is a hidden opportunity for those who understand the rules of this new market. It's a market split along geographic lines, generational divides, and even professional versus accidental landlords. If you know where to look, who to target, and how to act, this period of upheaval could be your chance to thrive. But get it wrong, and you could end up trapped in negative equity or paying far more than you should. Over the next few minutes, we're going to break down exactly what's happening, why it's happening, and where the opportunities are hiding. By the end, you'll know not just the facts, but the strategy you need to protect your finances and maybe even profit from one of the biggest market shifts in decades. So let's dive in, starting with the state of the UK housing market today. The UK property market is in turmoil, but it's not a simple, uniform crash. Across the country, house prices are behaving differently depending on the area, creating what experts call a fractured market. Nationally, the average house price has dropped around 3 to 4% over the past year. That's the headline, but the reality is much more dramatic in certain regions. Take London and the southeast. Here, prices have fallen by 6%, 7%, and even 8% in some postcodes. Homes that were worth $600,000 just a year and a half ago are now struggling to reach $550,000. Sellers are desperate, and the market is moving in ways that are almost unrecognizable compared to the past decade. In some neighborhoods, homes can sit unsold for months, despite being priced below market value because buyers are hesitant and waiting for an even better deal. Meanwhile, in other parts of the UK, particularly the north and some areas of Scotland, prices are holding steady or only declining slightly. Here, affordability hasn't broken down and investors are still active, making these regions a haven for cash flow-focused property buyers. This split is critical. Understanding where demand exists versus where it has evaporated is key to navigating today's market. The drivers behind these changes are complex. It's not just a case of interest rates or inflation. It's a combination of interest rates, buyer confidence, the exodus of landlords, and shifting demographics. Add in the ongoing impact of remote work and government schemes like Help to Buy, and you have a perfect storm that's reshaping the landscape of UK property. One striking example, consider a property listed at $600,000 in London in 2023. Today, the same property might sell for $550,000, wiping $50,000 off the value in under 2 years. For homeowners, this can feel catastrophic. For buyers, it's a rare chance to negotiate, but only if they understand the underlying dynamics and act strategically. This fractured market is the first clue. Not all declines are equal, and not all opportunities are obvious. Some areas are collapsing while others are quietly thriving. Understanding this contrast is the first step toward navigating the UK housing market today. But why is this happening? Let's break down the biggest factor next: interest rates. Interest rates are at the heart of the current crisis. The Bank of England has kept rates elevated to combat inflation, and mortgage rates have responded accordingly. Today, borrowers are seeing rates of 5%, 5.5%, and even 6%. For some homeowners, that's a huge shock, especially for those who bought in the last decade when rates were near historic lows. Think about it. If you purchased a property between 2010 and 2022, you may have only ever known rates of 1%, 2%, maybe 3%. That made mortgage payments manageable even at high property prices. But now, the affordability equation has changed overnight. Here's a real example. Imagine you bought a house in 2020 for $350,000. You put down a $50,000 deposit and borrowed $300,000 at a rate of 1.8%. Your monthly payment would have been around $1,320. Fast forward to 2025, your fixed rate deal has expired and refinancing now costs 5.5%. That same mortgage jumps to $1,760 per month, a $440 increase every month, over $5,000 a year, for families already facing higher energy bills, rising groceries, and stagnant wages. This is a financial squeeze they can't manage. The consequence? Many are selling, not because they want to, but because they have no choice. Hundreds of thousands of homeowners in this situation are hitting the market at the same time, flooding it with supply. High interest rates aren't just hurting homeowners, they're freezing the market. Buyers are cautious, sellers are panicking, and the result is a vicious cycle of falling prices. But rates are only one piece of the puzzle. Buyer confidence is collapsing too, and without demand, the market can't stabilize. Let's dive into that next. Buyer confidence has evaporated. Potential buyers are sitting on the sidelines, hoping prices fall further. They don't want to catch a falling knife, and when everyone waits, transactions stall. The result? Transaction volumes are down 30–50% in some months compared to previous years. Sellers panic when their homes don't sell and start reducing asking prices to attract the few buyers still active. It becomes a downward spiral. Prices drop, buyers wait, prices drop again. In a frozen market, only the most aggressively priced properties sell. Everything else sits unsold week after week. This lack of confidence isn't uniform either. Investors, particularly those focused on cash flow rather than capital gains, remain active in regions where rental yields are still attractive, like the North and Midlands. But in London and the Southeast, buyers are absent. This geographic split is critical to understanding where opportunities lie. While buyers hesitate, supply continues to rise, not only from homeowners but also from landlords. And the landlord exodus is the next major factor driving prices down even further. Over the past few years, landlords have been exiting the market in record numbers. Nearly 20% of landlords sold last year, while only 8% bought new properties. Recent surveys suggest over 40% of landlords plan to reduce or exit their portfolios in the next few years. Why? Economics have shifted dramatically. Mortgage rates for landlords are higher than ever, rental income hasn't kept pace, and regulations like the removal of Section 21 have made managing tenants riskier. Taxes have changed too, loss of mortgage interest relief, capital gains tweaks, and scrapping of furnished holiday-let benefits. Interestingly, it's not professional landlords leaving. Large investors with diversified portfolios are still buying strategically. It's accidental landlords, the ones who inherited properties or held onto old flats, that are flooding the market. These are people who were never in it for long-term investment but assumed property always appreciates. Now they're selling in droves, adding thousands of properties to the market and driving prices down further. For first-time buyers, this surge in supply can be an opportunity, but it also increases competition among sellers, creating more downward pressure on prices. The last decade of UK housing has been dominated by one of the most controversial government initiatives in recent memory, the Help to Buy scheme. Between 2013 and 2023, this program made buying a new-build home seem easier than ever. For first-time buyers, it promised a helping hand with deposits and mortgages. But in reality, it created distortions in the property market that are still reverberating today. At its core, Help to Buy inflated the price of new-build properties. Developers knew that buyers could access government-backed loans covering 20% of the property's value. As a result, asking prices rose significantly, sometimes 10–20% higher than equivalent properties in the resale market. Buyers entered these contracts thinking they were getting a deal, only to discover that they were paying a premium for the privilege of government assistance. Now, years later, the consequences are clear. Many Help to Buy buyers are stuck in negative equity. Imagine a couple who purchased a flat in 2018 for $280,000 with a 20% government loan. Fast forward to 2025, the property is only worth $250,000. Despite paying the mortgage diligently for 7 years, their equity is lower than when they started. This isn't just numbers on a page. It affects financial security, future borrowing potential, and the ability to upgrade or move. But it's not just individual buyers who are affected. The new build market itself is facing a slump. Developers are struggling to sell homes that were priced based on inflated expectations. Incentives like free flooring, contribution to deposits, or furniture packages are common, but these gimmicks often mask the real problem. The base price is still too high for buyers to commit. Even investors who once saw new builds as a safe bet are now cautious, particularly given the combination of higher interest rates, tax changes, and falling resale values. The Help to Buy hangover is also shaping regional disparities. In London and the southeast, where new builds were heavily concentrated, buyers are particularly vulnerable. Many overspent, expecting continual capital growth. Now, with prices correcting, the losses are stark. Meanwhile, in the North Midlands and Scotland, the impact is less severe, as pricing was more conservative and demand remains stronger relative to supply. This situation highlights a key lesson for anyone entering the property market today. Always compare new build asking prices with resale values. Independent valuations are critical. Just because a developer markets a property as brand new or modern doesn't mean it's a good deal. Overpaying today could lock you into negative equity tomorrow. In short, the Help to Buy era created winners, losers, and a lingering imbalance in the housing market. Understanding where new builds are overpriced, which regions are still viable, and which incentives are genuine can make the difference between a smart investment and a costly mistake. And while many people focus on falling prices, the real opportunity lies in spotting these mispriced assets before the broader market catches on. But there's another layer that's reshaping the landscape: the dramatic shifts in London caused by remote work and migration patterns. That's where things get even more interesting. London has long been the crown jewel of UK property, but its dominance is being challenged in unprecedented ways. For decades, London was the safe bet. Property prices almost always rose, rental yields were steady, and global demand seemed insatiable. Today, however, the story is very different. One of the biggest forces reshaping the capital is the rise of remote work. Since 2020, millions of Londoners have discovered they can perform their jobs from anywhere. Tech workers, financial professionals, and office-based staff no longer need to live in the city centre. Suddenly, cities like Manchester, Birmingham, Leeds, and Newcastle became viable alternatives. The lure is obvious: larger homes, lower prices, better quality of life, all while keeping London-based salaries. This migration has created two opposing effects. First, property supply in London has surged. As people move north or to smaller cities, they list their homes, increasing inventory. Second, demand from local buyers has slowed, as many are priced out or hesitant to compete in a market that feels unstable. The result? Average house prices are dropping, particularly in previously high-demand areas like Zone 2 and Zone 3. Some postcodes have seen declines of 7 to 8% in just the past year.
At the same time, the rental market behaves differently. With fewer people buying and many sellers turning to renting instead, rental demand in London has remained high. Rents have risen in some areas, creating a strange scenario where buying is cheaper than renting for certain property types, but overall, affordability remains a challenge. Investors with cash flow strategies are now carefully targeting London's rental market, but only in neighbourhoods with consistent demand, central locations, near transport hubs, or close to universities and major employers. London's property slump also highlights generational inequalities. Older homeowners, who bought decades ago, have significant equity and can weather the storm. Younger buyers, particularly first-time buyers, face massive deposits and higher mortgage rates, limiting their purchasing power. This generational gap is widening, influencing everything from market mobility to household formation patterns. The combination of migration, remote work, and generational shifts means that London's property market isn't collapsing. It's evolving. Understanding these trends is critical for anyone trying to navigate the capital's real estate. It's no longer just about location, it's about lifestyle, remote work feasibility, and timing. As London transforms, opportunities are emerging elsewhere. The North, Midlands, and selected regional cities are now the focal points for growth, yielding returns that would have been unimaginable in the past. While London struggles with an exodus, regional markets are quietly thriving. Cities such as Manchester, Birmingham, Liverpool, and Newcastle offer opportunities that are hard to ignore. These cities combine affordability, strong rental demand, and room for capital growth, making them ideal for both investors and first-time buyers. Rental yields are particularly attractive in these areas, often ranging from 6 to 8% compared to London's 4 to 5%. Investors are drawn to neighbourhoods with universities, hospitals, transport hubs, and growing employment sectors. For example, areas surrounding Manchester's business districts or Liverpool's waterfront developments are seeing high rental demand. The key is to focus on fundamentals rather than speculation. Properties with strong infrastructure and consistent demand will perform better in the long run. For first-time buyers, regional markets provide a real chance to get on the ladder. Unlike London, where deposits are astronomical, cities in the North and Midlands allow buyers to secure a property without overextending finances. Families can purchase larger homes, enjoy better local amenities, and avoid the financial stress that has plagued the southeast. Even developers are taking notice. New build projects in these regions are more reasonably priced, avoiding the inflated premiums seen in London and the southeast. Incentives are real rather than cosmetic, making transactions smoother and more transparent. However, success in these markets isn't guaranteed. Buyers and investors need to approach with discipline. Conservative budgeting, realistic cash flow calculations, and understanding potential void periods in rental properties are crucial. Overestimating demand or underestimating costs can quickly turn a promising investment into a liability. The broader lesson is clear. The UK property market is no longer London-centric. Growth, opportunity, and stability are increasingly found in the regions where rising demand meets sensible pricing. Those who act now, informed and strategic, are likely to benefit the most as the market continues to adjust. And yet, even in these opportunities, uncertainty remains. Economic shifts, interest rates, and government policies could all alter the trajectory, which leads us to the final section, the forecast and what to watch for next. Looking ahead, the UK housing market is entering a period of cautious correction. Analysts expect prices to fall another 3 to 5% through 2025, with London and the southeast likely to see slightly larger declines. While headlines often dramatise these drops, the reality is nuanced. Not all areas will behave the same, and opportunities exist for those who understand the dynamics at play. Several key factors will determine how the market evolves. First, interest rates. If the Bank of England decides to cut rates, borrowing will become more affordable, buyer confidence will improve, and prices may stabilise. Conversely, if rates remain high or climb further, the affordability crisis will deepen, forcing more sales and extending the downward pressure on prices. Second, employment and wage growth. The market can absorb higher prices if wages keep pace with mortgage costs. But with inflation pressures still present and wage growth lagging, many buyers are constrained. Job security also plays a role. Any spikes in unemployment could trigger forced sales and sharper price declines. Third, government interventions. New schemes, tax incentives, or relaxed planning rules could support demand and spur new construction. Conversely, stricter regulations or reduced support could slow transactions further. Fourth, generational divides. Older homeowners with significant equity are insulated from volatility. Younger buyers who are entering the market at a disadvantage face higher risks and must be strategic. Understanding these differences is essential for predicting trends and identifying opportunity. Finally, regional disparities will continue to widen. London may remain volatile, the southeast could experience selective recovery, and the North and Midlands will likely be the strongholds for both investment and first-time buyers. Timing, location, and market knowledge will be the difference between success and failure. In essence, the UK property market is neither crashing nor stable. It's transforming. Understanding the factors shaping these changes and planning strategically is the best way to navigate uncertainty. The UK property market of 2025 is a study in contrasts. Prices are falling in some areas, rising in others, and the old rules no longer apply. For homeowners, it's a reminder to stay calm and focus on long-term strategy. Panic selling is rarely the solution. For buyers, patience, research, and strategic decision-making are essential. Opportunities exist, but they require understanding the details: location, mortgage rates, property fundamentals, and emerging demographic trends. Investors should focus on cash flow rather than speculative gains. Regional markets, particularly in the North and Midlands, offer the best potential for steady returns. Understanding supply, demand, and tenant behaviour can turn uncertainty into profit. Conversely, London and the South East require more caution, patience, and selective investments. The overarching lesson is this: knowledge is power. By understanding the forces driving price changes, buyer confidence, landlord exits, and government interventions, anyone can make informed decisions that protect wealth and create opportunity. The market is changing, but those who act strategically will emerge ahead. And here's the key takeaway for viewers. Whether you're buying, selling, or investing, focus on fundamentals, think long-term, and don't be swayed by hype or fear. The market rewards patience, preparation, and informed decision-making. So, take a step back, analyze your options, and position yourself to thrive in the new landscape. The UK property market isn't dead. It's evolving, and evolution always creates winners for those who are ready. If this video helped you understand the market, hit like, subscribe, and comment with your predictions for UK house prices. Stay informed, stay strategic, and the opportunities could surprise you.